Fair Value Hedge Accounting under IFRS 9. In this video, I'm going to cover exactly what Fair Value Hedge Accounting is, what its key components are, what fair value risk is, the requirements for its recognition under IFRS 9, what the accounting treatment is, as well as a practical example at the end to really help you understand the concept. So let's get stuck in. Firstly, you might ask, what is the purpose of a fair value hedge? Well, ultimately, it comes down to risk management. A company would choose to enter a fair value hedge for risk management purposes. Fair value hedging provides protection against changes in the fair value of an asset or liability due to market fluctuations. As we know, there is uncertainty over the future fair value of an asset or liability. In other words, an asset or liability that you hold today is unlikely to have the same exact fair value at some time in the future. Fair value changes due to a wide range of factors, which we will cover later in this video, but we've referred to them here as market fluctuations. Given this potential for fair value movements, a company may wish to enter a fair value hedge to mitigate the fair value fluctuations that it may otherwise encounter. There are two key components of a fair value hedge that you must understand. The first is the hedged item. This is the terminology we use when we are referring to either the asset or the liability that we are looking to protect against fair value fluctuations. The second component is the hedging instrument. The hedging instrument is going to be some form of a derivative. So this could either be an option, it could be a future, it could be a forward, it could be a swap that is entered into to create the hedge that will provide protection against the fair value movement. So you might be asking, how does entering into a derivative instrument create protection against fair value movement of the hedged item? The important thing to understand here is that the hedging instrument that is adopted and entered into must have a negative correlation to the hedged item. Let's say, for example, a company wishes to enter a fair value hedge for a liability it currently holds on its balance sheet. So it currently has a liability that it is looking to protect. In this example, the hedging instrument that it would adopt would be a derivative that is negatively correlated to that particular liability. What this means is that if the fair value of the liability that the company is hedging increases in fair value, you would expect that the corresponding hedging instrument that has been entered into to provide a hedge decreases in value when that occurs. So these movements effectively offset each other. And by doing so, this effectively offsets the movement and reduces or eliminates the fluctuations that would otherwise occur. Alright, fair value risk represents the fact that future fair value is uncertain. It is often in line with the risk management policies of a company that significant fluctuations in their net asset positions are avoided as much as possible. And therefore, fair value hedging can be used as a tool to ensure this. In other words, companies may adopt fair value hedging to mitigate this fair value risk and offset the negative impacts in market variables. So what exactly are the market variables that contribute to this fair value risk? Well, there are certainly many different market variables that contribute to fair value risk. There are interest rates that change, there are commodity prices, foreign exchange rates change in the future, equity prices, inflation rates, and supply and demand dynamics that are all unpredictable to an extent. The aim with fair value hedge accounting is to reduce fair value volatility, not to generate profit. If an arrangement was entered into with the intent to make profit, it would not meet the definition of a fair value hedge, and that is something important to understand. IFRS 9 outlines a number of requirements that a company must adopt to recognize a hedge as hedge accounting. The main requirement is that the company maintains formal documentation that details specifics over the exact nature of the hedged item, the hedging instrument being the derivative that is used to create the hedging relationship, the nature of the risk being hedged, so this could be interest rate risk or foreign exchange risk, for example, as well as the objective and strategy for undertaking the hedge. So it must outline some sort of framework that is going to be used to actually execute the hedge. The formal documentation that is maintained must also stipulate how the hedge effectiveness is going to be measured and assessed. So what do we actually mean by effectiveness? Hedge effectiveness requires that there is an economic relationship between the hedged item and the hedging instrument. As we discussed earlier, for a hedge relationship to arise, there must be a negative correlation between the hedge item and the hedging instrument. For this to be the case, there must be an economic relationship between these two key components. Next, the effect of credit risk, being the risk that one party defaults, must not dominate the value changes that arise from the economic relationship. Credit risk is inbuilt within the value of a derivative instrument. It effectively creates a discount to acknowledge that there is a risk that one party to the derivative instrument may default, with the other party losing out. This discount, representing the credit risk, must not dominate the value of the derivative instrument that is entered into. It is unlikely going to be the case that this is ever encountered, depending on the nature of the derivative. However, this is something to consider. Finally, the hedge ratio, being the ratio between the quantity of the hedged item and the hedging instrument, must be aligned with a company's risk management policy. So as we mentioned, the purpose of a fair value hedge is to provide protection against fair value movements. A company does not necessarily need to hedge the full value of an item it wishes to hedge. Instead, it may only hedge 40% of it, for example, if it deems that this proportion or hedge ratio would be significant enough to reduce volatility in line with its risk management policy. Let's now get stuck into how we can recognize and record the journals for a hedge accounting relationship, after of course ensuring that we have met the requirements. By the way, if you're getting value out of this video, I would greatly appreciate it if you could take a minute to like this video and subscribe to my channel. If you have any questions or would like any accounting concepts explained, please let me know in the comments. Okay, so the first step in accounting for a fair value hedge is to determine the fair value of the hedging instrument at the reporting date. Step 2 is then to recognize the change in fair value in profit or loss since the last reporting date. So this could then lead to either a debit or a credit to the hedging instrument and a corresponding debit or credit to gain and loss of the hedging instrument. So one being an entry to the statement of financial position, being the balance sheet, and one being an entry to the profit and loss statement, in other words, the income statement. Step 3 then turns to the hedged item, which requires us to determine the gain or loss on the hedged item that is attributable to the hedged risk. And the final step, step 4, is to adjust the carrying amount of the hedged item and recognize any gain or loss in profit or loss. Similar to what we've done for the hedging instrument, we would then either debit or credit the hedged item, depending on the movement, with a corresponding gain or loss on the hedged item flowing through to the profit or loss or income statement. This provides a good framework or structure in applying what you should do when accounting for a fair value hedge. To close things out, let's now run through a worked example so you can understand fair value hedging using a practical example. Unique Furniture, which we'll refer to as UF, is a furniture company that imports and distributes furniture. Its functional currency is the Australian dollar. This effectively means that it reports in Australian dollars. On the 30th of November 2022, UF entered a firm commitment to purchase €5 million worth of furniture from Scandinavia. A firm commitment simply means it has entered a contractual obligation to purchase this €5 million worth of furniture. This furniture is to be delivered on the 31st of March 2023, which is when it is also required to be paid for by UF. UF has a risk management strategy to hedge all foreign currency purchases over 1 million Australian dollars. UF has a balance date of the 30th of June. So in this question, we are being asked to create the journal entries as at 30 November 2022, 31st of December 2022, and the 31st of March 2023. So let's apply what we've learned so far. From this example, we understand that the risk we would be looking to hedge relates to foreign currency risk. There is the risk that between the 30th of November 2022, which is when we entered into the firm commitment, and the 31st of March 2023, which is when UF is required to actually make the payment, there may be adverse movements in the Australian dollar to euro dollar foreign exchange rate. In other words, the Australian dollar equivalent of the $5 million euro payment is going to be different at the 30th of November 2022 and the 31st of March 2023. UF would therefore be looking to enter into a hedge to protect against this risk and fix the variability in the AUD to euro foreign exchange rate. The hedged item is therefore the $5 million euro payment that UF has committed to. So in this example, what is the hedging instrument? Well, a hedging instrument should be a derivative that effectively hedges the foreign currency risk. A common derivative that can achieve this is an FX forward contract. This derivative effectively allows us to lock in an Australian dollar to euro dollar foreign exchange rate now so that we know exactly how much in Australian dollars UF needs to pay when the 31st of March 2023 comes around, which is when UF is required to make the payment. This derivative therefore fixes the otherwise variable foreign exchange movements, being the risk UF would have been exposed to. This table here includes detail that we can't derive from the question above, but it tells us what the foreign exchange rates are, as well as changes in the fair value of the derivative since inception. So let's address the question. First, what are the journals at the 30th of November 2022? Well, this is an easy one, as there are no journals required at the 30th of November, as a firm commitment in itself does not result in the recognition of a transaction. No transaction has occurred. UF has simply entered into a commitment to make a payment at a future date. So what about the journals at the 31st of December? We can see from the detail provided to us that there has been movement in the fair value of the derivative. So we can see that the fair value is negative 125,000 as at the 30th of December. There has also been a change to the forward exchange rate to the 31st of March, which is when payment is required to being made. There has also been a change to the forward exchange rate to the 31st of March, which is when payment is required to be made. So thinking about the accounting framework we ran through in the previous slide, we must first determine the change in the fair value of the hedging instrument. We can see that there has been a negative movement in the fair value of the FX forward, which is the hedging instrument. We therefore recognize this loss in the P&L by debiting the loss on FX forward account. This account, of course, has an expense nature, therefore we are debiting to increase the expense recognized, being a loss of 125,000. Again, this 125,000 has been provided to us in the question, and it is not something that we can derive from any other detail in the worked example. Given the fair value movement has resulted in a loss, and we are not settling the derivative as at the 31st of December, which is when we are recording this journal, the other side of the entry is going to be a liability. It is a liability because we have a future obligation to close out this FX forward at 31st of March, which is currently sitting in a loss position. So that is step one done. We have recognized the movement in the fair value of the hedging instrument. The other journal we must enter is for the hedged item. When the commitment was entered into on the 30th of November, the forward exchange rate was 0.64. However, at the 31st of December, the forward exchange rate is 0.65. To understand this movement in Australian dollar terms, we can divide the 5 million euros by both of these rates to determine the movement. So if you were to divide the 5 mil euro by 0.64, you would get an Australian dollar value of $7,812,500. And if you were to do the same for the forward exchange rate as at the 31st of December, you would get a Australian dollar value of $7,692,308. So the difference between these two is equal to $120,192. And that, of course, is Australian dollars that we're looking at here. So a way to actually interpret this is that if we were to consider the 5 million euro payment as of the 30th of November, which is when the commitment was entered into, we would have to pay an Australian dollar equivalent of 7.8 million Aussie dollars. Now that it is the 31st of December, there has been a favourable movement in the forward exchange rate such that we are now paying less in Australian dollar terms, being 7.7 million. This $120,000 difference is therefore favourable. To recognise this, we recognise a gain to the profit or loss of this amount, as well as a corresponding fair value item asset for the amount of the difference seen. And that represents the second step of the accounting framework applied. Let's now record the journal entry as at the 31st of March, which is when UF is required to make payment. Stepping through the same process, we instead now see that the fair value movement of the derivative has swung into an asset position. So the fair value is now 252,000, whereas at the 31st of December, it was negative 125,000. We therefore need to reverse the liability recorded at the 31st of December and now record an asset equal to the amount of the fair value movement. So we can see that we have reversed out the previously recorded liability, as well as recorded the 252, which is the current period fair value movement here. The other side of the entry to balance the journal is the growth movement from inception, being the $377,000. Again, that is the first step done. So now let's turn to the hedged item. So for the hedged item, again, we can see that there has been an inverse movement. So the forward exchange rate at the 31st of March is now 0.62, which is in the opposite direction to the movement seen from inception to the 31st of December. So the movement at 31st of December was an increase over the inception value. However, now it has gone down to 0.62, which is lower than the value at inception. In a similar fashion, you would then have to reverse out the previously recorded asset and recognize now a liability in the fair value of the hedge item. We would follow the same process by dividing the 5 million euro by the new forward exchange rate to determine the difference that we now come to. And that calculation will allow you to arrive at 252 if you take the difference between the rate as at 31st of December versus the 31st of March. Again, the loss recognized to the P&L is going to be the gross up of the two. Again, the amount recognized, or the loss in this instance recognized to the P&L, is going to be the gross up of the two fair value movements. So let's take a step back and look at this final journal. Here we can see that we ended up with a loss on the firm commitment, being the hedge item. However, we have a gain on the hedge instrument to an amount that is roughly equal to each other. The movement in the Australian dollar to euro dollar exchange rate has therefore been hedged, as this gain and corresponding loss effectively offset each other. This is exactly what a fair value hedge aims to achieve. And that, in effect, is how fair value hedging works. So thank you for watching this video. Should you have any questions, please leave me a comment below and I'll get back to you. Otherwise, I'll see you in the next video.